This video. In this session, as a part of the Guide to International Business Introduction to Trade Finance series, we are talking about risks. Risks in international or a cross-border business. The cross-border business activities, any commercial activity in another country is required in international trade because the buyer and seller may be in the same country, but the goods can be coming from a third country, or the seller or a buyer could be in another country, or the goods are being procured or originated or from a third country. So, this international trade or cross-border commercial activities enable the businesses to expand their reach so that you get new materials, new products, new markets, and new counterparts. This helps in capitalizing the opportunities available across the globe because of the globalization that is happening in the economy today. But these expose the corporates to a wide range of risks. This can significantly impact the operations. This will affect your profitability and this could impact your reputation. So, this review tries to take us to the various risks associated with our international trade transaction. And this overview provides some examples, some challenges, and some of the methods of mitigation of these risks and the way in which we can strategize to handle these challenges. Now, cross border trade risk is very important because of the various forms of risk, the financial risk is most important. It is significant because the challenges that the companies, the corporates face when they are engaged in cross border trade are very high in the ranking for potential to cause damage to your balance sheet. This can manifest in various forms and have very high impact on the profits also. Most important of the financial risk is the currency risk, where the exchange rate fluctuation or the volatility significantly affects your profit margin. The value of the realization or the value of your investment will be affected by the currency risk. For example, a company in US sells machinery to a company in Germany for 1 million euro. And if the euro dollar rate goes up or down, and if the payment term is 90 days, so the value of realizable dollar on day of shipment and the value of realizable dollar on the 90th day, that's a day of payment, will be different because the markets are moving every day. So if the euro weakens against the dollar during this period, the US company will receive less dollars. So technically, your profit may come down in dollar terms. So the challenge is unpredictable currency movement. What you can do is to enter into a long term contract in foreign currency, or if you have a multiple currency exposure, they may cancel out each other or sometimes complicate also. So hedging in the form of forward contract or options or swaps is what is important for you. Next, what you can look at as an exporter is for a natural hedge. And finally, you should have your pricing strategy that includes currency fluctuation clauses. Then comes the interest rate risk. Interest rate risk is the potential for the market where the rate of interest at which you have borrowed for procuring the goods is floating and changing regularly. Like if a company takes out a loan in a foreign country with a variable interest rate, and if the interest rates rise, the cost of servicing the debt also increases. So the divergent monetary policies has an impact on your financing cost. And if you are borrowing in multiple countries, then what happens is the various countries will have different days on which the policies move in different directions. So the volatility is more. And this is because of the influence of the various economic events, domestic and international. So it will be important for a corporate to manage your debt portfolio, especially when it is in multiple currency. One of the mitigation strategy that you could look at is the interest rate swap to convert the variable rate into fixed rate. Another could be diversifying funding. And third could be matching the currency debt with the currency of cash flows. So that if you are earning in euros and if you are repaying the loan in euros, it would be a natural hedge. Then comes the credit risk. Credit risk is the cross border in a cross border transaction, that is something that the buyer or a business partner may fail to pay or the seller may fail to supply. Now, in credit risk, what happens is a supplier extends credit to a foreign party. You are selling on a 90-day term, for example, but the party during these 90 days diverts the goods or doesn't pay or becomes insolvent or bankrupt. What is the challenge? There is a limited information on the foreign company's creditworthiness if your KYC or due diligence is inadequate. Maybe there are difference in bankruptcy laws. Maybe that you have not taken care of the regulatory and legal requirements on the risk mitigation angle before the trade transaction. Maybe there is a creditor protection available or not available, you are not aware. And longer the payment term, longer the payment cycle, which is normal in international trade, you have a higher risk. What could be the mitigant? Conducting thorough due diligence is a mitigant. Using trade credit insurance is another way. Implementing secure payment methods like a confirmed letter of credit where you have to rely upon only your bank and not the overseas bank or the country or the political risk is what you are exposed to is another way of managing this credit risk. Then comes the political and country risk. What is a political risk? The political risk is that the regulation may change because of the political compulsions of the local economy. It could be economic conditions, it could be social conditions. The instability, the political instability in a country is the most important form of the political risk. Because the governments are unstable, maybe the policies will also undergo flip flop changes very frequently. The regime change will bring about changes in the regulations. Regime change could be preceded or succeeded by civil unrest, which will again trigger a policy shift. So, this will affect the cross border business operation. The challenge is unpredictable policy change or disruption to business or disruption to regulations or changes in the or what do you call the government action that leads to seizure of your assets or prevention of you remitting the dividend or the royalty could also be one risk. What can be done? Diversifying across multiple countries is one option. Obtaining political insurance from ECAs and other agencies is another option. And then you should always have plans for rapid exits when you are in an unknown country where the situation is deteriorating fast and you have no other option to stay back. What are the regulatory changes that come in? Regulatory changes are alteration to the law or regulation, or changes in the tariff, or uh, introduction of a new free trade agreements, or other barriers to trade. For example, if there is a pharmaceutical company that is expanding into a new market, then you expect an unexpected change that the drug approval process has been abruptly changed and then you are not able to launch, then it will increase your cost and you would have already incurred the cost, then that cost can never be recovered. So keeping up with the evolving regulations in new jurisdictions is very important. Adapting your practices to the new situation is very important. And then you should also look for how to handle the retroactive implementation of certain rules. The best thing is to get into tie up with a local entity who will be in a better position to navigate these risks. Most important political risk is the expropriation risk. What is expropriation? That means the government may seize the private property and may not provide adequate compensation. For example, you have a mining license over a period of 7 years, and on year two, there is a change in government and they seize your mining rights. Then you lose control over the resources. There is a limited recourse when there is a government doing a nationalization effort. There is a potential for gradual creeping expropriation also. Sometimes it could be increases in tax or the royalty payments. Sometimes it could be changes in the valuation. What could be the mitigation? Purchasing political risk insurance could be the most important mitigation. Engaging a local community could also help in a certain way. Most of the time, it should be in the form of a structured bilateral trade agreements. What are the operational risks? In a cross border trade, operational risks are challenges for the businesses as well as the countries and governments and other banking institutions involved due to different cultural and regulatory background. There could be supply chain disruptions. What does it mean? The physical supply chain may not be able to provide you the performance of supply. How? Because of a natural disaster, because of geopolitical events, because of strikes or other issues in the logistics. Now, if you are relying on components from a single supplier, then you will have a problem when there is a delay in the supply, maybe because the factory is damaged by a typhoon or there is a fire accident, etc. So that is why people now call as India plus one, China plus one type of alternative supplier for you, so that you don't have a limited visibility, but and you don't have a dependence on a critical supplier. You can balance the cost efficiencies by having a diversification, by implementing a supply chain that can be monitored for early warning segments or systems or signals. Most importantly, maintaining a safety stock is good for critical component, but it comes with a carrying cost. Let us turn our attention to cultural and language barriers. This leads to misunderstanding. The barriers lead to inefficiencies and then potential conflicts. One needs to have a, for example, marketing campaign to be successful in another country. And if you do not understand the cultural sensitivities, and if your marketing campaign is insensitive, or if there is a mistranslation or a misunderstanding, then it will spoil everything that you have planned. So, misinterpretation of the ethics, misinterpretation of the um, ways and means and traditions of the society, not understanding the cultural norms could create problems for a cross border trade. So, employing diversified people in the team could help us to understand the local nuances. And one need to invest in professional translation and localization. Localization is more important than translation. Let us turn our attention to logistics and transportation risks. What are logistics and transportation risks? Cross border trade often involves complex requirements in the form of transport, warehousing, loading and unloading, freight forwarding, insurance, etc. If it is perishable goods, all the more important. If the perishable goods cannot cross the customs border easily, then by the time the goods reach, the spillage or the spoilage could be good enough to cause a heavy financial loss. So, navigating these procedures, ensuring that the documents are clean and correct, managing the transportation, ensuring the handshake at various transfer points or transshipment points is proper, ensuring the integrity of the product, the cold chain, the security of the product is most important in a cross border trade. What we can do as a corporate, we can work with experienced and professional freight forwarders and customs brokers. We can implement track and trace, maybe IoT. We can also look at contingency plans for routing and modes. If you turn from moving a container from a ship sea mode of transport to air mode of transport, the cost will increase. But then you will manage or look at whether this cost of air shipment versus the cost of not having the goods on time will be of help to you or not. Contract enforcement is also a challenge in the form of a legal and compliance risk. Legal and compliance risk arise because of the complexity in understanding the different legal systems. The jurisprudence in different countries pose different challenges. There is a potential for bias against the foreign entities or potential for the regulatory agencies favoring the local entities. So if you have to win a legal battle with a foreign partner, then you will have difficulty in enforcing the rules in the foreign country. The variation in laws, the variations in the interpretation, the lengthy process, the complexity in the litigation, and the bias or belief in bias could cause various challenges in the dispute resolution. So, our clauses in the contract, our norms for arbitration, our need for a neutral forum is what needs to be brought up in the beginning of the entering of an agreement. We also need to look at whether we have had adequate due diligence in our ability to enforce the contracts in a foreign country. Then comes the intellectual property. A technology company enters into a new market only to find counterfeit versions of its products widely available, eroding the market share and brand value. This is a very famous news that you get every other day. This is because of the changes in the laws or changes in the way the intellectual property is interpreted or enforced across different geographies. It is not easy to register the intellectual property right or to defend it in every country. Technology transfer requirements or a localization, local component requirements, or during a period of 5 to 7 years, the technology should be transferred to the local entity requirement in different countries are very common nowadays. One of the option could be partnering with a local industry organization to ensure there is minimal infringement on your rights. Then comes the anti-corruption laws, anti-bribery law, or foreign corrupt practices law. So a company will face hefty fine or penalty in addition to the financial and reputational damage if it is discovered that it paid to some entities something which locally is called a bribe. Now there are varying definitions of anti-corruption or bribery or um, legal interpretation of these aspects in different countries. So what is a gift according to you could be a bribe in the local definition. So balancing competitive pressure with ethical business practices is very important. So here we need training for the employees to understand the policies and procedures that needs to be adopted in the local government interactions. Then comes the risk of cyber security, data protection. We today rely more on digital technologies. So data protection and cyber security has become one of the critical aspects of our day-to-day business, especially when we are across the border, because data breaches can result in not only loss of sensitive business data, but privacy of the customer and intellectual property, and this could have a heavy reputational and financial penalties. If the organization is not having adequate ways and means to prevent a cyber attack, to prevent data from being leaked, then there will be legal consequences which will be very difficult to handle. So, protecting data across different infrastructure in different countries, keeping up with evolving cyber threats, and complying with the regulatory regimes is very important. This can be done by implementing robust cyber security measures, updating your, for example, antivirus software regularly, or the internet firewalls regularly. And the most important thing is the developing a regular testing plan and the incidents response plan and the marketing plan as to how you respond in case something untoward happens. There could be a requirement for data localization also. Data localization is certain types of data need to be stored within the borders of the country and you cannot store it in the cloud. This will add to your cost, but this will provide you compliance with the local regulatory requirement. This may also add some sort of operational efficiency in retrieval and proving to the regulators that you are in line with the regulation. So one need to ensure data protection from the hardware angle also in that situation. And we need to map the data flows to the storage locations, implement classification, and engage with the regulator that they to their satisfaction. What are environment and social risks? The environment and social risks are becoming very important today because of the ESG considerations. Companies need to navigate the various anti-pollution law or the sustainability regulations of the local countries because it causes environmental damage, financial fines, and reputational risk. Implementing global environment management system, managing reputational risk by being associated with environment protection agencies, balancing the cost consideration versus the regulatory requirements, engaging in the local communities or the non-government agencies or the environment groups to understand and implement the local requirements will all be important. What are the local labor and human rights issue? Across the border, it is difficult to manage the labor practices because of the gaps in understanding. You may face consumer boycott or legal action if the local economy feels that you are supplying from a country which is manufacturing using, for example, child labor. So, managing the labor practice across the supply chain, ensuring reputation, again, balancing cost pressure versus the compliance requirement, implementing a robust supply chain where end to end auditing is possible, collaborating with industry initiatives to ensure there is a balance of the rights and responsibilities. All this is important. Otherwise, cross border commercial activities will, while offering significant opportunity for businesses to grow and expand, may also put us into trouble in the form of legal risk or a reputational damage or a financial penalty or a market boycott, etc. because of the complexities of the regulations, norms across the border. What are the key to manage these risks? It is to identify and assess the risk across various aspects, implement appropriate risk mitigation strategy, continuously monitor the evolving risk landscape, and foster a culture of awareness, training the employee and ensuring compliance all the time. So, by understanding and effectively managing this, it will be possible for us to take our business globally.